It's no secret that house prices across Australia have been climbing steadily in the last few months. More and more people are eager to invest in property, but they're not sure where to start. In this video, we'll break it all down in one go. The current state of the housing market, why prices are on the rise, how each city's market might develop over the next year, and which city makes the most sense for buying for massive capital growth. In the end, I'll share a city where prices are skyrocketing, yet I wouldn't advise our Vision members to buy there. I hope this guides you toward a decision that aligns with your own investment goals. Hi, I'm Alex. I hold master's degrees in accounting and business administration. When I worked as an accountant and then a GM of a listed real estate company, I began my property investment journey. Then I started my own company, helping hundreds of people invest in the property market to achieve financial freedom and retire early. And you're watching AusPropertyStrategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. To see the big trend clearly, we have to weigh the forces on both supply and demand. Everyone who follows Australia's housing market knows the Prime Minister's plan. Build 1.2 million dwellings in 5 years, that's 240,000 a year. The plan is there, but what about the reality? Since 2016, monthly building approvals have topped out at about 23,000, averaging near 18,000. In May, June, and July 2025, approvals set between 15,000 and 17,000 a month. On a yearly basis, that's only around 190,000 to 200,000 approvals. And approvals aren't completions. Many never get built. Look at 23 to 24, approvals hit a 10-year low, which means completions in 25 to 26 won't be strong either. After approval comes commencement. Once a project starts, you can roughly guess how many new homes will reach the market in 1 to 2 years. Housing commencement is a leading indicator. In Q1 2025, total commencements were 46,000, up a touch from the record low in July 2023, but still not normal by the past decade's standards. Even if all 4 quarters of 2025 match that pace, we'd see about 185,000 starts. That's 55,000 short of 240,000 annual target, a 23% gap. Completions make it clearer. This chart shows rolling annual totals by quarter. Across the 4 quarters, including Q1 2025, Australia completed only 176,000 residential dwellings. From 2021 to now, not a single year has exceeded 180,000. You might say, what about public housing? Sure, but it barely moves the needle. Over the past decade, public housing completions averaged roughly 1,000 per quarter, peaking around 1,400 and dipping to about 650. That's only 4,000 a year. It doesn't fix anything. So the gap between the PM's target and reality is real. Each year, we are short by about 50,000 homes. It's easy to spot the approvals shortfall, but an overlooked factor matters just as much. Not every approved home gets built. Latest data show 34,000 dwellings nationwide are approved but not commenced, up 8.3% year-on-year. What does that tell us? Developers have permits, but construction costs are so high that they won't break ground. Housing Industry Association figures are shocking. The average build cost has jumped to 480,000, up 52.6% from about 330,000 pre-COVID. The same house now needs an extra 150,000 to deliver. The real problem is that the materials remain expensive. Copper pipes and fittings up 14.4%, electrical cable up 9.5%, even basic clay bricks up 8.3%. The Productivity Commission reports that housing construction productivity has fallen 53% over 30 years. For the same hours, we now build only half as many homes as in 1995. A bricklayer asks $500 to $600 a day, and you still may not get one. With this cost structure, builders' margins are squeezed, so they don't want to start building unless prices climb, which is why, against the real-world constraints, the goal of 1.2 million homes in 5 years looks like wishful thinking. Think supply is bad enough? The real crunch is on the demand side. Start with migration. ABS data show that in the first 9 months of 24 to 25 financial year, net permanent and long-term arrivals reached 366,000. Permanent residents arriving minus leaving, plus arrivals on visas over 12 months minus departures. The full year is tracking around 385,000. That's down from 446,000 in 23 to 24, but still well above pre-COVID. What does it mean? In less than a year, roughly 340,000 new residents will need a place to live. SQM Research's July 2025 report puts the national residential vacancy rate at just 1.2%. Sydney at 1%, Melbourne about 1.2%, Brisbane around 1.3%, all far below the long-run 2.5 to 3%. Looking for a rental? In hotspots, a listing can be gone in under 3 days. Nationwide, it's only 10 to 14 days. The outcome is obvious. Rents and prices are rising together. Is that normal? I studied economics and keep close eye on Australia's economy, so here's the classic model. Rents and prices usually move in opposite directions. When prices jump, investors enter, supply lifts, rent growth cools. When rents rise, some tenants buy, prices lift, investors add stock, and rents ease. But there's an exception. When supply tightens while demand surges, both can climb at once. And that's today. New construction is too slow. In some cases where a development application was approved, 5 years pass before a single home is finished. Demand is even more intense. Government incentives plus a surge in population, the national vacancy rate is just 1.2%, which means out of every 100 rental homes, barely 1.2 sit empty. At 3%, the market is balanced. At 2%, rentals are scarce. At 1%, you can hardly find anything. Today's 1.2% is a decade low. No wonder rents are jumping. Australia has seen price-rent twin surges before. From 2015 to 2017, rising materials and labor costs and longer approval timelines collided with peaks in Chinese and Indian migration, tipping supply and demand out of balance. Sydney's median prices rose over 10% per year, while rents still grew about 5%. The post-pandemic period is the second example. Everyone lived through it. In a balanced market, due rises are rare. In today's unbalanced one, they're likely to stay in the next 12 months. And it's not just migration. Multiple rounds of stimulus have juiced the market. The Help to Buy shared equity scheme launched in the late 2024 lets first home buyers put down just 2%, with the government taking 30 to 40% equity. Many jumped in. By mid-2025, the RBA eased gradually to 4.1% in February, 3.85% in May, and 3.6% in August, while banks discounted mortgages below 3.5%, boosting borrowing power, and an additional 5% deposit scheme lands on 1st of October. With demand outpacing supply, policy running hot, migration out in front of dwelling growth, and building capacity choked by high costs, heavy regulation, and weak productivity, ordinary buyers and renters face fewer choices. Rents keep climbing, deposits keep growing. In this cycle, the acceleration has only just begun. If you have any questions about property investment, please book a free 15-minute discovery call on our website. If you want a team offering one-stop service to help you build a property investment portfolio, achieve financial freedom, and retire early, join our Vision membership by booking a 30-minute obligation-free discovery session to start with. Or to keep it simple, our data-driven buyer's agency service can help. We buy and manage properties for our clients anywhere in Australia. Links to the service are in the description below. In August, the national market rose 0.7%. Only Hobart slipped 0.2%. If you look at the trend lines, you'll see that every city, Hobart included, is either rising or turning up. Sydney is speeding up, Melbourne is easing, mid-sized capitals like Brisbane, Perth, and Adelaide are surging, and the smaller cities are also in positive territory. For deeper city-by-city numbers, check the previous episode. Digging into the data, the drivers aren't evenly spread. They're concentrated in a handful of hot pockets. On Sydney's North Shore, prices rose 1.2% month-on-month. The inner west gained 1.3%, while the western suburbs added just 0.4%. Around Melbourne CBD, values climbed 0.9%, but the outer suburbs were up only 0.2%. The message? The course premium is pushing upward. The city center's moat is widening. This also split between dwelling type. Detached houses rose 0.9%, while non-detached lifted 0.3%. ABS data show non-detached new supply has lifted to 31%, yet high-rise apartment completions fell 18% year-on-year due to labor shortages and delayed materials. In other words, demand for non-detached hasn't fallen away. Tighter supply is setting up more pricing power. That said, I still won't recommend non-detached as an investment. It's not that the price can't rise, it's just that in the long term, houses tend to outperform. Plenty of people ask how long this run can last and when a pullback might start. The major banks and consultancies all have outlooks. For 2025, the big four banks expect Sydney to rise between 3% and 7%. By August, Sydney had already topped 3.3%, a lean toward roughly 6%. For Melbourne, the range is 0 to 6%. My estimate is 4.5%. For Perth, most put it at 5 to 8%. I'm at 8.5%. For Brisbane, 5 to 8%. I'm at 8%. Among the banks, ANZ is the most bullish. NAB is the most cautious. KPMG sits medium to high. There's no directional split this time. Everyone's calling gains, which brings us to the real question. Over the next 12 months, if you can only buy one property, which city should it be? Brisbane's performance has been outstanding these past 2 years, both year to date and in August alone. It's well ahead of the national average. Two factors sit behind it: local Queensland investors returning and confidence lifted by the major infrastructure. As long as the RBA doesn't hike sharply, the window to get in is still open, but it's clearly narrower than in 2024. Many Brisbane houses now sit above $1 million. At that price, you could pick up an entry-level house in Sydney's growth corridors. Perth's post-pandemic run has stunned traditional investors, from indifference to curiosity to acceptance and then regret. Regret what? Not buying earlier. While the pre-COVID mining slump weighed on prices, tight labor and scarce supply are now pushing values higher. Our on-the-ground intel shows a rise in settled land lots, but construction is not started. The gap from land settlement to construction start has blown out to roughly 6 months, signaling supply bottlenecks are back. If you're entering now and plan to hold long-term, it's a buy. The next 12 months look great. Over 3 to 5 years, I'm still positive, and longer holds are even safer. Sydney eased in April, then locked into a strong upswing over the following months. CBA says if the RBA trims another 25 basis points before year-end, Sydney prices would gain an extra 0.6% in 2025. Right now, buyers are paying about 8.2% above asking to secure listings, which shows there's still a premium in the market. Sydney is the nation's most expensive city, and many dismissed it while the mid-sized capitals were roaring. Those who bought near Sydney's trough are smiling now. But can you still buy it now? In percentage terms, I doubt Sydney outpaces the three mid-sized capitals in the short to medium term, but as the foundation of a property portfolio, I'm comfortable. Historically steady with solid upside, it's a buy and hold city. Melbourne has drifted sideways. Since February, it has risen every month, but never faster than 0.5%, and August even eased back, unlike other cities that are accelerating. That tells me investors remain split. My take: for investment, look elsewhere first and circle back to Melbourne later. For an owner-occupied, buy now, don't hesitate. If I had to rank the above cities with budget aside, number 1 would be Brisbane, number 2 Perth, number 3 Sydney, and then Melbourne. When Darwin's upcycle became clear earlier this year, I briefed our team, don't recommend Darwin. I see it rising and expect it may keep rising for a while, yet we still haven't advised our Vision members to buy, not because Darwin properties can't make money, but because it doesn't fit. Our philosophy is to find the right property, buy, hold, and not sell. We invest for the long term, not quick flips. Over a 10 to 20 year hold, I believe Darwin has a high chance of underperforming other cities. If you're chasing a short-term win, that's your call. If your goal is quick profit, why buy property at all? If you can't explain that in 3 sentences to a 10-year-old, you shouldn't be buying in Darwin. It's a fact Australian housing is getting expensive. At the current pace, within 5 years, even with subsidies and lower rates, many ordinary people still won't be able to buy. For them, owning a home here isn't a right. It's a privilege for those who have the money. Is it fair? I'd say no. Is it caused by investors? Partly. Will I keep investing? Absolutely, and I'll work to help more Vision members reach their wealth goals through property. But for many everyday Australians, the dream of owning will drift further away. Unless you're outstanding at work or in business, you may have to say goodbye to that dream. The old Aussie dream, get a job, then buy a home, has become unrealistic. Only those who work hard and build businesses will manage it. Then what happens? New migrants will buy at higher rates, while third-generation plus locals will buy at lower rates because a sizable share of long-established locals simply don't want to push. Their motto, I'm poor, so I'm right. I'm lazy, so I'm noble. The government must look after me. Housing is my right. The more people who think like this, the less likely Australia is to have a future. 2 kinds of people rarely succeed. First, the timid. When a task appears, they list 10 obstacles. This won't work, that's unsafe. They'll never see an opportunity and reject it by habit. Doers think differently. They plan, start, then solve any problems. That's where growth begins. Second, the lazy, just no execution. The wealthy people look for projects to do, driven by a sense of urgency. Those lazy people often look down on everything. This job feels beneath them. That one pays too little. To make something happen and make money, number 1, you need to have ideas. Number 2, execute. Number 3, solve problems. Just thinking without doing is empty talk. Just pick something and start. If you don't know how, learn. And if you don't have the money and still won't push, you won't get a shot. Marching with unions, joining protests, venting online, then going back to the same timidity and laziness won't change anything. If you want a home, you need to earn it. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.